Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone.
Glad to be here.
We are diving deep into the raw source material today. We've got a whole stack of reports from CNBC, Bloomberg, Yahoo Finance.
A lot to get through.
There is. And our mission really is to cut through all that noise and understand three, I think, massive forces that are colliding in the market this week.
Okay.
You've got this specter of extreme valuation volatility, then a sudden sharp shift in what the Federal Reserve might be thinking, and some really consequential corporate leadership drama happening behind the scenes.
It's an environment of absolute financial whiplash, which I think makes this deep dive essential.
Whiplash is a good word for it.
It is, because you're seeing this dual reality play out in the headlines right now. On one hand, you have extreme anxiety.
Right.
It's fueled by the recent market rout, that recurring discussion about the everything bubble.
But we're going to get to that.
And that suggests deep structural problems. But then, at the exact same time, you see this instant policy-driven euphoria tied to just whispers from the central bank.
So the market isn't just choppy. It's swinging wildly between two extremes.
Violently oscillating
Yeah.
between, existential fear and very short-term policy hope.
Okay, let's unpack that fear factor first, because that is what's dominating the narrative. We saw these wild swings in global stocks, driven almost entirely by worries over AI valuations. The CNBC article on this, the one about the AI bubble, even noted that NVIDIA's huge earnings news, well, it offered a sigh of relief for maybe a day.
If that. And then the gains were just eroded by those same valuation concerns.
It highlights that core conflict, doesn't it? Are these stocks justified, or are we in, classic bubble territory?
Well, and that's where Dan Hanbury from 91 took this debate a step further. He actually coined the term everything bubble.
Everything bubble. Okay, so what's fascinating here, according to the source, is that he's moving beyond just simple tech hype.
Right. His argument is that this is a systemic crisis. It's driven by the confluence of two main things. First, overvalued U.S. stocks, yes. But also, and this is the important part, the ongoing normalization of interest rates.
The discount rates. Let's get specific on that for the listener. What does that actually mean in plain English? Because it sounds like something that crushes tech, but Hanbury says it's hitting everything.
That is the crucial insight. Think about how assets are valued. Long-duration assets like property or the future earnings of a tech company.
Okay.
You estimate future cash flows, and then you discount them back to today to figure out their worth right now. The rate you use for that calculation is fundamentally tied to interest rates.
So if the Fed keeps the base rate higher, the rate I use to discount future money goes up.
Precisely.
Yeah.
And for years, money was basically free. Discount rates were near zero. So future earnings looked huge today.
Right.
Now that rates are higher, every future dollar, especially one 10 or 20 years out, is worth significantly less today. Hanbury's point is that this hits the valuation models for everything, not just startups, but property portfolios, debt instruments.
The whole landscape.
The whole landscape, hence the everything bubble.
That structural argument is persuasive. But if it's an everything bubble, why did major players jump back in on Friday on just a hint of a rate cut?
Well, that's where the nuance comes in, and it's why Oliver Jones from Rathbones disagrees with that apocalyptic definition.
He's not buying it.
He's not. He noted that while U.S. tech and AI stocks are, his words, undoubtedly expensive, the excess is not uniform across the market. It's not like the 2000.com peak.
Okay, so what are those historical signals we're missing then?
Jones pointed out two key missing indicators. First, a massive pickup in equity issuance companies rushing to sell new stock.
And second,
a surge in M&A activity across the board. Both of those are pretty subdued right now, which suggests, institutional discipline hasn't totally broken down.
Right? It's concentration in AI, not blanket hysteria. And to give listeners a quantitative check on this, Michael Field from Morningstar offered a useful counterpoint.
He did. He provided some crucial grounding. He said at the time of the call, his team saw U.S. stocks as trading at almost a 5% discount to their fair value estimate.
A discount. And Europe.
Europe was near a 3% discount. He was specific, though. He said, Tesla and NVIDIA looked overvalued to him, but giants like Alphabet, Meta, Microsoft, they still had upside.
So the takeaway is you have to be discerning. It's segmented.
It's not a monolith waiting to pop.
Which brings us perfectly to the macro driver that threw the market that lifeline last week, monetary policy. Let's look at the revival of rate cut hopes.
the market shifted almost instantaneously. The catalyst was comments from New York Fed President John Williams. He signaled he sees room for a potential third rate cut this year.
And for context, the target rate is what, 3.75 to 4%?
Correct. And the market just loves any hint that the tightening cycle is truly over.
And futures traders went wild. They are now pricing in roughly a 70% chance of a quarter-point cut in December. That's a huge psychological shift.
It's monumental. It was up from, what, 44% just a week earlier? That one comment just provided a massive shot of adrenaline.
And that expectation of lower rates, it has immediate, tangible impacts on certain assets.
Gold is the classic example. Lower rates, they reduce the opportunity cost of holding something that doesn't give you a yield, like bullion.
Makes it more attractive than bonds.
Exactly. Bloomberg noted that gold pared its recent losses. It's consolidating near $4,070 an ounce. And that's largely fueled by this policy hope after surging 55% this year.
But we're relying on signals from the Fed while assessing the true health of the economy is still incredibly difficult.
Because of the shutdown.
The historic 43-day government shutdown. We have this mountain of delayed data finally coming out, so investors are still flying half blind.
Absolutely. The lack of reliable data just adds another layer of volatility. Every new release is treated like a crisis signal.
And this week we're getting September retail sales and, crucially, the Producer Price Index, the PPI.
On Tuesday, yeah.
Okay, let's define that for the listener. We always hear about CPI, the Consumer Price Index. Why is PPI so important for a rate cut decision?
Well, PPI is critical because it measures the price changes from the perspective of the producer, the factory, the service provider. Think of it as pipeline inflation.
What's coming down the pike?
Exactly. If PPI is high, producers will eventually pass those costs to consumers, and CPI goes up. If PPI comes in soft, it gives the Fed more confidence that inflation is easing at the source.
And strengthens the argument for a rate cut.
Precisely.
So we have market anxiety, policy optimism, data confusion, and yet Treasury Secretary Scott Bessent, according to CNBC, remains the dedicated optimist in this whole mess.
Bessent is selling optimism on a specific timeline. He's very, very optimistic on 2026 and is confidently predicting the U.S. avoids a recession.
Okay, what's his rationale?
It's rooted in policy, specifically the ongoing impact of what he calls the One Big Beautiful Bill Act.
That's a politically charged name, but what is it, actually? Why is he betting on it?
The main thing he's pointing to is making the 2017 tax cuts permanent, plus adding some new tax breaks for corporate investment. He's banking on that to drive growth.
But he's not ignoring the problems.
No, he did acknowledge the challenges. Persistent inflation in services, and he specifically noted the struggles in interest rate-sensitive sectors, like housing.
And on the policy front, he also confirmed a big announcement is coming on healthcare costs this week.
That's a crucial one for millions of households. They're trying to address the looming expiration of the expanded ACA subsidies,
which are set to end in 2025.
Right. So this announcement will be about how they plan to mitigate that cost cliff for insurance affordability.
Okay, let's move from the U.S. macro situation to global market divergence. There's a market that is not experiencing any valuation fear at all: India.
This is one of the most remarkable stories right now. It's a textbook case of what you'd call valuation arbitrage.
Training.
Global corporations are listing their local Indian units because the domestic market there assigns these massive, sometimes illogical premiums to them, premiums the parent company could never get internationally.
The numbers are just staggering. The source cites LG Electronics India. Its local unit is valued at $12.6 billion.
And its Korean parent company.
$10.1 billion. The subsidiary is valued higher than the entire parent company. It defies logic.
It does. And the valuation multiples tell the whole story. The Indian unit trades at 58 times earnings. The parent company, a meager 9 times.
So why is that happening?
2 things. First, the local units have much faster growth. But the real driver is deep domestic liquidity.
Where's all that capital coming from?
It's this explosion of retail investors and local mutual funds in India. They have limited places to put their money for high growth, and these MNC subsidiaries fit the bill perfectly.
So the global firms raise cash at huge valuations.
And it helps prop up the parent company's share price by signaling all this future growth potential.
That kind of divergence really highlights the challenges facing established U.S. tech giants.
Yeah.
Let's pivot back to California and talk about Apple's transition.
Right, the Yahoo Finance report. Tim Cook has been CEO for 14 years. The succession question is very active.
And the spotlight seems to be on John Ternus, the hardware engineering SVP.
It is. Cook prefers internal picks, and Turnus definitely has that Apple DNA.
The anecdote about him in the source is fantastic. Tells you everything about the culture.
It does. A known perfectionist. He apparently got into a huge argument with a supplier over whether a screw should have 25 or 35 grooves.
Wow.
That level of detail is, what's required at Apple, but it also signals the challenge for the next leader. You can't just focus on the microcosm.
Right, because he's inheriting these colossal external pressures that a screw groove count won't solve.
Exactly. The next CEO has to navigate the Department of Justice antitrust lawsuit right out of the gate. Plus, this relentless criticism from Wall Street that Apple is behind on generative AI.
Which analysts see as an existential threat to their dominance?
A huge threat.
So while Apple's question is who will lead them into the AI future, the story at Microsoft is about the tough reality of selling that future today.
Yeah, the CNBC piece on this was really interesting. It detailed the unexpected sales hurdles for Microsoft's Copilot tool.
They're selling it as a $30 per person per month add-on. That's a big ask.
It's a significant extra cost, and consultants are reporting that a lot of customers just aren't seeing the value to justify it.
I could just hear the CFOs balking at that.
They are. The report quoting clients saying things like, "I don't even want it." It seems the value proposition isn't immediately obvious enough.
So the sales reps have to actually sell it now, not just take orders.
They have to prove the ROI. It really highlights the gap between the AI hype and real-world budget constraints. And that struggle is made harder by the competition.
Right, Google's Gemini 3.
Exactly. A Microsoft partner noted that Gemini recently migrated a 16,000 employee company. So even in Microsoft's core territory, rivals are posing a very serious threat.
Okay, let's close out by focusing on how geopolitics is creating these sharp, immediate reactions in asset prices. The reports on U.S.-Ukraine peace talks.
They immediately drove specific market segments down. The sharpest reaction was a big sell-off in European defense stocks.
Companies like Rheinmetall in Germany.
Rheinmetall Saab in Sweden, they all fell sharply. The stock's Europe Aerospace and Defense Index dropped to its lowest point since July.
And that was purely on sentiment, on Secretary Rubio reporting highly productive peace talks.
Yes, the market is pricing in an end to the conflict, but analysts were quick to offer a structural counterpoint to that drop.
They were surprised by how sharp it was.
Very. Because structurally, they believe the defense spending story is still intact. They argue that regardless of a short-term peace deal, the long-term increase in European defense budgets is here to stay.
So they see this as an emotional overreaction.
An overreaction to headlines, yeah. Not a reflection of the long-term revenue pipelines for these companies.
And energy prices followed a similar path, reacting to potential supply changes.
That's right. Brent crude slipped toward $62 a barrel. But the really big move was European natural gas. It hit an 18-month low.
And that's specifically because of Russia.
Specifically, yeah. The prospect that if sanctions were lifted as part of a peace deal, significant volumes of Russian gas could re-enter the market and just crush prices.
Okay, finally, let's loop back to the U.S. housing sector. That area Secretary Bessent flagged as struggling. A Yahoo Finance report shows the split in the market is just extreme.
It's a fascinating microeconomic paradox. It's high interest rates colliding with aggressive construction.
And in a lot of major cities, rents are actually falling.
Falling significantly. Places like Denver and Austin, the source says drops of 5 to almost 8% year on year. There's a massive supply of new apartments hitting the market.
So landlords are getting desperate, offering things like 12 weeks of free rent.
Massive concessions. But if you're a renter, you're staying put because the alternative is so much worse.
The cost to buy.
The ownership premium is just punishingly high. CBRE calculates the median premium to own a home versus rent is a staggering 108%.
So it costs more than double to own than to rent.
On average, yes. And that reality traps renters in place. It actually leads to high renewal rates, which is paradoxical. Landlords know you have nowhere to go, so you get the one-time concession, but the base rent stays high.
So to synthesize this week's sources, we've seen global volatility from the everything bubble debate, a psychological lifeline from the Fed, and these sharp market segmentations from geopolitics and things like liquidity flows in India.
And if you connect all that back to the broader picture of asset leadership, despite all the capital being concentrated in the Magnificent Seven, there are really important signs that market strength is broadening.
Okay.
Last week, Eli Lilly reached a $1 trillion valuation. It's the first healthcare company in the world to join that club, which has always been dominated by tech.
That's a huge milestone.
It is, and it's fueled by the potential of their weight loss drugs. It shows that a powerful, non-AI-driven narrative can still challenge the dominance of big tech. It suggests you need to watch sectors with disruptive innovations in health, in energy, in infrastructure, because the leadership board may be expanding.
We'll see you all tomorrow morning with new headlines from major financial magazines.